Picture this. Right now, millions of investors are celebrating. They're checking their portfolios with huge smiles, feeling like geniuses. The S&P 500 just pulled off something extraordinary, climbing nearly 20% in just 6 weeks after bottoming out in early April. We just witnessed the fastest recovery after a 15% drawdown since 1982. That's the fastest I've seen in my entire lifetime. Every single year-to-date loss was erased in 6 weeks flat. But while everyone's popping champagne and patting themselves on the back, something sinister is brewing beneath the surface. The smart money, the institutional investors who've been through this dance before, they're not celebrating. They're getting nervous. Very nervous. And I'm about to show you exactly why the next 90 days could make or break your entire portfolio. Because what I'm seeing right now looks eerily familiar to patterns that have destroyed wealth before. Hit like and subscribe if you want to stay ahead of what's coming next. Here's the uncomfortable truth that nobody wants to hear. When markets move this fast, when recoveries happen this violently, someone always pays the price. And that someone is usually the last group to realize what's really happening. Think about it. A 20% surge in 6 weeks isn't normal market behavior. It's the kind of move you see when fear turns to greed overnight, when rational thinking gets thrown out the window. The last time we saw this exact pattern was back in 1982, and here's what most people don't remember about that period. Yes, there was a massive recovery, but it was followed by months of brutal volatility that caught everyone off guard. The investors who rode the wave up ended up giving back most of their gains because they mistook a relief rally for the beginning of a new bull run. Right now, millions of investors are about to learn a painful lesson about gravity. What goes up fast often comes down faster, and the signs are already there if you know where to look. While retail investors are diving in head first, convinced we're off to the races for the rest of 2025, institutional money is quietly positioning for something very different. They're preparing for a pullback, and they're doing it for 3 very specific reasons that most people are completely ignoring. I call them the 3 horsemen because just like in the old stories, they're harbingers of what's coming. And they're converging right now to create what could be a perfect storm for the markets. The first horseman is the tariff time bomb. Anyone who thinks the tariff story is in the rearview mirror is fooling themselves. While politicians shake hands for the cameras and talk about progress, a massive trade war worth over $1.5 trillion is still raging beneath the surface. Right now, there are tariffs on pretty much every country inhabited by humans. I'm not even joking. There are tariffs on countries inhabited only by penguins and seals because of trade loopholes. But here's where it gets serious. 2 of America's biggest trading partners, the European Union and China, still have no real deals in place. That so-called agreement between the US and China a few weeks ago? It wasn't much of an agreement at all. It was just kicking the can down the road. And now we're basically back to square one with both sides going after each other in the media for violating their handshake deal. With the EU, Trump put 50% reciprocal tariffs on European goods, though they've been delayed until July 9th. People are calling this delay a positive step. But here's what they're missing. The EU is actually a bigger trading partner than China, with $976 billion in total trade in 2024 compared to China's $582 billion. When you're talking about that much money in limbo, the market is sitting on a powder keg that could explode in either direction. The second horseman is the earnings illusion. We just wrapped up Q1 earnings season, and everyone's celebrating because results were better than expected. But here's the dirty secret that Wall Street doesn't want you to know. Most of those goods that companies sold in the first quarter were bought and stockpiled before the tariffs hit. They were essentially serving food they bought before inflation kicked in. Now companies are having to reorder, and those new goods being sold in the second and third quarters? They've got tariffs attached to them. Companies have 3 choices when dealing with these higher costs. They can eat the costs themselves, pass them on to consumers, or do some combination of both. But no matter which route they choose, it's going to hurt. Let me break this down with simple math that shows you exactly what's happening. If a product used to cost $15 and a company sold it for $30, they had a healthy 50% margin. But now, with tariffs, that same product costs $19. If they still sell it for $30, their margin drops to 37%. To maintain that same 50% margin, they'd have to raise their price to $38. Either way, there's going to be a trickle-down effect. Lower earnings, compressed margins, and unhappy consumers or shareholders. The third horseman is the valuation trap. This might be the most dangerous one of all because it's hiding in plain sight. Right now, analysts are still expecting 9% earnings growth for 2025, targeting S&P 500 earnings per share around $265, which is actually down from the $270 estimate at the start of the year. But here's the problem. The market has been rising rapidly, while earnings expectations are getting revised downward. Using those current earnings estimates, we're looking at a forward PE ratio of 22.4 times. Compare that to the 18 times average over the past decade, and we're in bubble territory. We have an S&P 500 that's been climbing like a rocket ship, but if earnings continue to lag and analysts start slashing their 2025 expectations even further, that overvaluation is only going to get worse. When reality finally hits this market, the fall is going to be swift and brutal. The smart money moves. Now, does all of this mean we should panic, sell everything, and hide our money under the mattress? Absolutely not. This is where the smart money separates itself from the crowd. While others are going to flee when the pullback hits, we're going to hunt for gold in the wreckage. There are always opportunities to make money, even when the broader market is falling apart. I'm going to give you two specific investments that could not only survive the coming pullback, but actually thrive during it. These aren't speculative plays or risky bets. These are strategic positions that professional money managers use to profit from chaos. The first investment is the Energy Select Sector SPDR ETF, ticker symbol XLE. This is the ultimate contrarian play, and here's why it's brilliant. Over the past 12 months, energy has been the absolute worst performing sector in the entire market. Year to date, it's the second worst performing sector within the S&P 500. When everyone abandons something this completely, that's usually when the smart money starts paying attention. Energy has been the ugly duckling that nobody wants to touch, which means there are high-quality companies trading at incredible valuations just waiting for their moment. And that moment might be coming sooner than people think. Oil prices are starting to ratchet higher, climbing 5.5% in just the past month alone, and now trading near $63 per barrel. There are still massive tensions in the Middle East. The Russia-Ukraine war is ongoing, and any escalation could push energy prices significantly higher. XLE is down 7% over the past 12 months, which means you're buying at a discount. It has an incredibly low expense ratio of just 0.08%, so you're not getting eaten alive by fees. The ETF holds 26 total companies, with the top 10 accounting for nearly 75% of the fund. We're talking about giants like ExxonMobil, Chevron, ConocoPhillips, Williams, EOG Resources, Kinder Morgan, Marathon, Oniok, Phillips 66, and Schlumberger. These aren't fly-by-night operations. These are established companies that know how to generate cash flow. But here's the cherry on top. By investing in XLE, you get a juicy dividend yield of 3.5%, with a 4.5% 5-year dividend growth rate. You're literally getting paid to wait while the sector recovers. When energy finally turns around, and it will, you'll be positioned to benefit from both price appreciation and steady income. The second investment is the JP Morgan Nasdaq Equity Premium Income ETF, ticker JEPQ. This is where things get really interesting because this fund uses sophisticated option strategies to generate income in any market environment. Think of it as financial Aikido, using the market's own force against itself. Here's how it works. GPQ managers buy underlying positions in the Nasdaq 100, but they also sell out-of-the-money call options on the Nasdaq 100 index. They're collecting premium from those option sales while owning the underlying stocks. It's like collecting rent on property you own, while still benefiting from any appreciation. The combination of dividends from the stocks plus the option premiums creates a powerful income stream. Why is this perfect for right now? Because if I'm right about a market pullback led by technology stocks, those out-of-the-money call options are going to be extremely profitable. When options expire worthless, JEPQ keeps all the premium, which allows them to pay higher distributions to shareholders. It's a strategy that can make money whether the market goes up, down, or sideways. JPQ currently manages $26 billion in assets, so this isn't some tiny experimental fund. Over the past 12 months, it's only down 3%, massively outperforming the broader market's volatility. But here's the real kicker. It's currently yielding an 11% distribution, and they pay it monthly. That means you're getting a paycheck every single month while waiting for the market to figure itself out. If you're looking for a place to park cash right now and earn serious income while you wait, JEPQ is absolutely brilliant. So here we are. The signs are all there, laid out in front of us like breadcrumbs leading to what's coming next. We've got a tariff time bomb that could explode at any moment. We've got an earnings illusion that's about to be exposed when companies start reporting their real numbers. And we've got a valuation trap that's going to snap shut the moment reality sets in. The fastest recovery since 1982 isn't something to celebrate. It's something to be cautious about. History has a funny way of repeating itself, and right now, we're seeing the same patterns that have caught investors off guard before. The question isn't whether a pullback is coming. The question is whether you'll be ready for it. You now have the roadmap that smart money is following. You understand why XLE could be the phoenix rising from the ashes of the worst performing sector. You know how JEPQ can turn market chaos into monthly paychecks through sophisticated option strategies. You have the tools to not just survive what's coming, but to profit from it. The crowd is euphoric right now, convinced that this rocket ship is heading straight to the moon. But you know better. You've seen behind the curtain. You understand that when markets move this fast, gravity always wins in the end. The choice is yours. You can follow the crowd off the cliff, or you can position yourself like the professionals do. What do you think? Are you seeing the same warning signs I'm seeing? Do you believe a pullback is coming? Or do you think this market is heading higher in the near term? And which of these two ETFs resonates with your investment strategy? Let me know in the comments below. Hit that like button if this analysis helped you see the market from a different perspective. And make sure you subscribe because the next 90 days are going to be absolutely critical for anyone with money in the markets. Your financial future might depend on the decisions you make right now. This video is for educational and informational purposes only. Investment performance shown is based on historical data and projections. Past performance doesn't guarantee future results. Always conduct your own research and consult with a qualified financial advisor before making any investment decisions. Thanks for watching.